Lesson 16, Trading Strategies. Before we get started, I'd like to point out this sign up in the top left-hand corner. It states important information. During this lesson, you will see that sign appear on certain corners of these slides. On that slide, there will be important information that can help you as a trader. You will also notice that at the bottom center, there's a number. Just in case you lose yourself during this lesson, all you need to do is match up this number with the number in your workbook, and you'll be caught up with where I'm at. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis. They're applicable to many financial markets. But I'd like to point out this very profound statement. Successful traders will do what unsuccessful traders can't and won't do. Change the word traders to people. Successful people will do what unsuccessful people can't and won't do. Success doesn't come from luck. Success comes from understanding how certain things work, buying into a clear education and a set of disciplines, and being true to those disciplines. People are not successful because they're lucky. As the old saying goes, you know, whenever I work 16 hours a day, I seem to get lucky. Successful people, successful traders are successful because they've taken the time to properly educate themselves about their niche. There's a 21-day 3% rule which states the human mind forgets 80% of the knowledge it acquires within 3 days. If you don't use it, you'll lose it, because at the end of 18 more days, a total of 21 days, you will have only retained 3%. And there's some great trading strategies in this lesson. Play this lesson over and over again until you clearly understand those strategies. Now, by the end of this lesson, you should understand that the market can only move up, down, or sideways. You'll learn how important it is to educate yourself before you trade in these markets. You'll also learn that there are several trading strategies that you can apply to becoming successful as a trader. You will learn that equity management is critical for financial survival. And you'll learn that as you trade, you will need to create a trading plan, and you will need to financially protect yourself at support or resistance in every trade. I would like to do a quick review from lesson 1, which is understanding how the market works from the beginning, in as much as we are watching Japanese candlesticks which monitor the open, high, low, and close of a time period, and that there's two types of candles, a bullish and a bearish candle. Look at this chart. See how the market goes up in price, and there are white candles, those are bullish candles. See how the market came back down, those are bearish candles. And that most traders watch a bid chart. In the market, there's a bid price and an ask price. There are people buying and people selling. The difference between the buy and the sell is called a spread. In currencies, there's usually between a 3 and 10 pip spread, depending on which currency you trade. Stay away from currencies that trade and have huge spreads. There are certain currencies that have 100 pip spreads. Stay away from those. Trade currencies that have tight spreads, that are very liquid, easy to get in and easy to get out. But what we're looking at is a bid chart. An ask chart looks identical to the bid chart. It's only higher than the bid chart. Now remember, we buy on the ask and we sell on the bid. Buyers at an auction buy from the seller. Sellers sell to the buyer. We are monitoring a bid price. Every buy should have two sells. If we enter buying at the market, we will buy at the ask. This is the current price of the bid. The ask would be 107.35. Our protective stop loss orders will be on the bid. Because we bought, we will have two sells, a sell limit for profit and a sell stop for potential loss. Those will be on the bid. Because we're monitoring the bid price, all it will take will be for the candle to hit it, and our order should be filled. Conversely, if we enter the market selling, we will sell on the bid. That will be the price we will get. Our protective stop loss order will be on the ask, which means if the candle rallies, it doesn't have to touch your ask price, and you will probably be stopped out because the ask will hit your buy stop before the bid will. Please remember that. There are three types of orders we trade. One is a market order. That's an order placed to enter or exit the market at the market price, either the bid or the ask, or whatever the price is at the time of our order execution. The second order is a limit order. That's an order placed to enter or exit the market at the exact place, price, or better with no slippage. A stop order is an order placed to enter or exit the market at an exact price that turns into a market order when touched. Stop orders turn into market orders, which then are subject to slippage. Now let's look at this chart. Here's where the market is. Any order placed above or below the market is called an open working order. It'll be an order that is unfilled. If you place an order to buy anywhere here above the market, that will be called a stop order. If you place an order to sell anywhere here above the market, that'll be called a limit order. If you place an order to buy below the market, that's called a limit order. If you place an order to sell below the market, that's called a stop order. Here's the ordering rules. If you're going to be a bull, every bull should have two sells, one for loss and one for profit. Let's look at this chart. You buy here for whatever reason. Lesson 6 talks about the sell zone. You'll need to place your stop loss order at the last low. It'll be a sell stop. Every buy has two sells. One sell for loss, one sell for profit. If you're going to short the market, be a bear wanting the market to go down, every bear should have two buys after they enter the market. One for profit and one for loss. Your stop order should be at the last high. OCO means whether you are buying or selling, you will need two opposing orders, one for profit, one for loss. When you OCO your order, that means one cancels the other. You can set it and forget it. Walk away from the computer. You don't need to sit there and watch it. Watching is not going to help you become successful in your trade. OCO means whichever the market hits first, it will cancel the opposing order and not leave you there with an open working order. Please keep in mind, canceling and replacing is all about chasing the market in an educated fashion. If you are canceling and replacing an uptrend, then cancel and replace only after the market has made a new high. Do not cancel and replace before that. If you are canceling and replacing in a downtrend, only cancel and replace to the new last high after the market has made a new low. Bulls want to buy low and sell high. They enter the market buying first and selling second. The broker gives you the right to be a bull and a bear. For whatever reason, if you enter being a bull based on a trading signal or a methodology, to make a profit you will need to buy low and sell high. Bears do the opposite. They enter selling first. But even though they enter selling first, they need to sell high and buy low. Bears want the market to go down. They reverse the transaction, and the broker gives you the right to do that, where you sell first and buy second, which means when you trade currencies, whether the market is going up or down, you can make money. And as you short the market 24 hours a day in currencies, there are no special requirements like trading stocks have. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. A chart is a chart is a chart. Technical analysts apply their knowledge to all charts, Why? Because anywhere you can pull up a chart, whether you're trading stocks, commodities, options, currencies, the rules have a tendency to apply to just about all charts. Once you've been educated on how to read charts, you will start to control your financial future. I'd like to do a quick review on lesson 2. Highs are candlestick formations where either the candle or the wick on either side, 2 to the left, 2 to the right, are lower than the candle or wick high. In a low are candlestick formations where either the candle or the wick is lower than the 2 candles to the left and 2 candles to the right. So the 2 to the left have to be higher than the low, 2 to the right have to be higher than the low. Not all lows are support and not all highs are resistance. Remember the game in lesson 2. If the bulls take control right now, they will try to take out all their levels of resistance, all their previous levels of resistance. If the bears take control, they will try to take out all your levels of support. What you want to do is train your eyes to be able to turn on a chart and just scan the chart and see all your previous levels of resistance and all your previous levels of support. Do not underestimate the financial game of the bulls and the bears. As you trade, all your protective loss stop orders must be at the last low if you're buying and the last high if you are selling. For whatever reason, if you enter the market here and you're buying, place your protective stop loss order at the last low. If you are selling or shorting the market, place your stop loss order at the last high, just in case the market decides to reverse itself. If the stop order is too far away from entry and does not meet your equity management requirements, then pass on the trade and go find another trade. Let's look at this chart. Here's a potential buy. Look at how your stop loss order, which would have to be at the last low, is too far away. Too much risk. This, because we're trading the euro, it pays $10 a pip. That means you would have to risk about $1,000 on this trade per lot. Too much risk. Pass on the trade. Go look for a trade that meets your equity management. If the price swings are too large, or if the price swings are large enough, you can place your stop at the last high or low. But if the price swing is small, you will need to place your stop beyond the high or low by 5 to 10 pips to avoid from being stopped out early due to the bid chart. Remember at the beginning of this lesson I pointed out there's a bid and an ask chart. The ask chart is an invisible chart that looks identical to it. It's just 3 to 10 pips higher. Because of that, as long as you have a large swing, now obviously this is a huge swing, you wouldn't trade this, but if your swing is large, you can place your stop if you're selling here at the last high. But if your swing is small, like here, and you enter into the market, and your protective stop loss order would be at the last low, i.e. right here, which might be only 20 pips away, you may want to put your stop order a little further beyond it, maybe 5 to 10 pips beyond it, to avoid getting caught up in any potential sideways movement. I'd like to review trends real quick. Remember, when the market is making higher highs and higher lows, you are in an uptrend. And we draw all our trend lines across the lows of support. See how we drew our trend lines across the lows of support? And there's 3 primary trend lines that we're constantly monitoring. One is an inner, an outer, and a long term. And our objective in trend lines, which we go into great detail in lesson 5, is to buy when the market hits the trend line. That's where the market bounces. Downtrends work identical but in the opposite direction. A downtrend is creating lower lows and lower highs. When you spot a downtrend, you draw your trend lines across the highs of resistance. These are the highs of resistance. See how we drew them across the highs of resistance? Now there's three primary downtrend lines that we're monitoring: a long-term outer, an and an inner. Trading outer and long-term downward trend lines, we will anticipate shorting the market when the market hits the trend line and bounces. Now lesson 16 focuses in on trading strategies. I think it's very important to have a clear trading strategy before you enter the market. Here's the hardcore reality of trading. Only 10% succeed, 90% fail. And that's because the 90% are novice traders who are jumping in the market before they properly educate themselves without a clear strategy of how the market works, trying to become lucky. Now, before you trade, you need to decide to either be a day trader or a position and overnight trader. A day trader is an individual that gets in today and gets out today. A position trader is an individual that gets in today and perhaps gets out tomorrow. Warren Buffett got in the market 40 years ago. He's still in. He's considered an overnight trader. Now, as you find a trade, you need to manage your risk. Many times we can't quantify how much money we can make on a trade. People that bought some of these tech stocks, they had no earthly idea how much money they were going to make. But we can quantify how much we're willing to risk and lose. Risk no more than 3 to 10% of your margin account or your trading portfolio on any given trade. Do not risk more than that. If the risk is too great, pass on the trade. Do you realize that many traders who hear about a hot tip, they will take all their family money, all their hard-earned money they've saved for years, and they'll dump it in the market on one hot tip. They'll risk everything on one hot tip. And what usually happens is they get burned because their greed exceeded their need. And when your greed exceeds your need, it'll usually take you down a path of self-destruction. There are over 40,000 different stocks to choose from. Why would you need to risk everything on one trade? If the risk is too great, pass on that trade. Go find another trade. You have over 40,000 to choose from. Now here's how you manage your risk. If you have a $5,000 trading account, you should risk no more than $500 on a trade. If you have a $7,500 trading account, to risk about $500 would put you at about 6.6%. If you have a $10,000 trading account and you risk $500, that would put you at 5%. Financial survival is the focus here. Do not risk more than 10% on any given trade. And do not overtrade your account. That means risk no more than 10% of your equity in any given trade. Going back, let's look at how on this one, $10,000. If you're risking no more than 10%, you would risk no more than $1,000. If you're risking more than 10% on any of this, you are over trading your account. Now, here's how you will be over trading your account. If you have a margin account of $1,000, that's all, and you risk $250 on a trade, which would be an extremely tight stop, you're risking 25% of your account. You're over trading your account. If you have $2,500 in margin and you risk $25 or $250, you're borderline right at 10%. If you have $5,000 in your account and you risk $250, you are only risking 5%. All trades have risk. Which one makes the most sense to you? Think of the emotional and mental state of this trader, of the trader who is risking 25% of his account on one trade. That means if the margin requirements are $1,000 per lot to trade, if you risk $250, boom, and the trade doesn't work out, you're out. You can't trade again until you send more money. You'll have to pass up on the next opportunity. If you risk $250 on $2,500 and you lose, you still have money left over. If you risk $250 on $5,000, you still have money left over. Who of these three would be the calmest mentally and emotionally? Obviously, the guy that started with $5,000. If he lost $250, look at how much money he still has left over. Now remember, the risk-reward ratio should be a minimum of 1 to 1.5. For every dollar you risk, you should go after at least $1.50 in profit. For every 400 you risk, go after 600. For every 800, go after 1200. Traders like the currency market because traders can make all kinds of money as it trends. The markets have a tendency to be very trending and can many times trend over 1,000 pips in a given week. Making money is fun. However, learning to take a loss in the market is the single hardest and most important lesson for a trader to learn. No one is a 100% winner at trading. Absolutely no one. But you have to learn how to take a loss. Now, percentages mean nothing. You can be a 30% winner and a 70% loser, and can you still make money? People have asked me all the time, what's your percentages of success? What does that really matter? Look at this. What if I said I was a 30% winner against a 70% loser? Would you think I was any good? Well, look at this. What if every time I traded I went after $2,000 gain and I won 3 out of 10? That means every 10 times I trade I made $6,000, but I kept my losses very small, which means 7 times out of 10 I lost. But my losses were at around $300 per trade, which means after 7 trades I lost $2,100. I still walked away with close to a $4,000 profit. Focus on your losses first. Keep them small and let your profits run, and success will come your way. Now, this is one of the main reasons why traders fail. They are trading to get lucky and trying to make money. Their greed usually exceeds their need. They think trading is a game of chance and luck and do not get the proper education to succeed. Here's an important one. They're usually not willing to pay for education or mentorship. And because of that, they usually end up with poor focus, and they have no defined trading strategy, which literally places them in a position to lose. And because they had to be told where to get in, or they're trying to get lucky, they're quickly introduced to their emotions, and they will operate more emotionally than intellectually. And the more emotional you are, the less money you will make. Now let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works will improve those percentages. The psychology of successful trading is this. You need to educate yourself on how the market works. You need to have a well-analyzed and well-thought-out trading plan. You need to quantify your potential loss in any trade and not risk everything on one trade. And you need not ever overtrade your account. You need to create a trading plan and trade that plan. You do not deviate from your plan without creating or having another clear trading plan. You need to maintain your focus. And whatever you do, do not marry a trade. Be quick to change directions, if that is what the chart's saying. Move from a bull to a bear at the click of a mouse. And when in doubt, stay out. Now the market is constantly on the move, and the Forex is no different. It is either moving up, down, or sideways. And as it's moving up, down, or sideways, it's creating formations. Look at this, sideways movement. Believe it or not, this sideways movement is a diamond pennant. Then it breaks out of that diamond pennant and starts to trend. You learned a lot about pennants in lesson 15, and you learned a lot about trends in lesson 5 and how to trade them. This is a great trading opportunity. But either way, the market's either moving sideways or trending. Now, there are several strategies that can work. However, what works in a trending market may not necessarily work in a sideways market. So if you are trading based on a system, you may want to have two trading systems, one for a trending market and one for a sideways market, which would mean you will have a trading or a trending strategy and a sideways strategy. That'll create balance. Now here are some strategies. This strategy number one is good for sideways markets as well as trending markets. You will enter the market with one lot. You will go for a small profit on that lot. You will exit right before the market takes out the next high or low, depending on the direction that you are going. You'll place your stop loss orders at the last high or low. Lesson 2 focuses in on that. You will not trade without a stop. Lesson 3 focuses in on that. So do not trade without a stop. And Lesson 7 discusses the correct placement of protective stops along with Lesson 3. Always look at your risk versus your reward and keep your losses small. Now let's look at it in a chart. If you enter buying here, go for a small profit right before the market makes a new high. You buy here, here's your last level of resistance. Get out before it makes a new high. That's strategy number 1. If you're selling, look at how you short the market here, get out before it takes out the previous low. That way you're just in for a short period of time. This is a 2-hour chart. Look at, if you shorted the market here, you're probably in for 2 or 4 hours. Trading strategy number 2. This is better for sideways markets and only okay for trending markets. But enter with several lots, 2, 5, or 10. Have a protective stop loss on all your lots. Go for a small profit. Exit right before the market takes out the high or low. Only go for a small amount of pips, 20 or 30 pips. 30 pips times 10 lots equals 300 pips. Times $10 per pip, that's a $3,000 move. You'll be in and out quickly versus a cancel replace. Your protective stop loss orders need to be at the last low if you're a bull and the last high if you're a bear. Do not trade without a stop. Lesson 3 and 7 discuss the correct placement of protective stop loss orders. Always look at your risk versus your reward and keep your potential losses small. But if you enter the market for whatever reason here and you're buying, you'll get out before it takes out the previous high of resistance on multiple lots. If you are shorting the market, you will short the market on multiple lots before it takes out the low. This way you don't have to wait and be in the market trying to capture 300 pips. You can capture 300 pips on 10 lots, only going for 30 pips. Now here's trading strategy number 3. This is good for trending markets and bad for sideways markets. Enter with one lot. Cancel and replace and get out when you get stopped out. But cancel and replace and get to a break even as soon as possible. Lesson 3 and Lesson 5 on Fibonacci's teach you this. Exit on a cancel and replace, going for a large profit until you're stopped out. Place your protective stop loss order at the last low if you're a bull and the last high if you're a bear. Do not trade without a stop. Remember, Lesson 3 and 7 discuss the correct placement of protective stop loss orders, which means for whatever reason, if you buy right here and your stop loss order is here, cancel and replace, chasing the market. It is not a greedy way to chase the market. It's an educated way to chase the market. But do not cancel and replace until the market has made a new high, which means if you entered here and your protective stop loss order is here, as the market has rallied, retrace back a little bit, cancel and replace your stop loss order to a break even as it's making your new highs, but then as it retraces back, cancel replace from here to here. Now that it bounces here and makes a new high, and retraces back, U-turns, establishes another new high, cancel replace from here to here. Do the same on a downtrend. Do not cancel and replace your stop loss orders as you chase the market until the market has made a new low. Now let's do a cancel replace exercise so you understand how to do this. As you practice cancel replacing, turn on your computer software and understand how it works before you enter the market. We've provided you with trading forms. Keep a track record of everything you do on your trading form. It allows you to go back and rehearse in your mind exactly what you have done. Now, we are going to make an indicator trade. We are going to enter the market based on an indicator that is telling us the market is turning from bearish to bullish. Indicator trades are lesson 4. It's well worth your time and money and investment to understand how to trade with indicators. Indicators can provide comfort to the trader. It can provide you with knowledge that the market is reversing. Be that as it may, here is an indicator that is telling us to buy. When the green line hits the red line, we're going to buy. Therefore, we're going to enter the market buying. Now, if we buy, we place our protective stop loss order at the last low. Because the swing is tight, we may want to go a few more pips beyond it, but we will place our stop loss order at the last low, and if we're going to cancel or replace, we will have no limit to get out. When you enter the market, fill out your paper trading form, go find all your levels of support and resistance, and remember, risk versus reward should be a minimum of 1 to 1.5. For every dollar you risk, you should go after $1.50. Now we have no limit as we chase this market. We have clearly quantified our potential loss if this trade doesn't work out. But keep in mind, before we move forward, we have no idea how much we can make. All we know is we've said, hey, here's where my potential loss is. I can live with that just in case this trade doesn't work out. Now look at how from our entry, right here, the market rallied, topped out, retraced, established a low, and now rallied again. Now the first thing we want to do is we want to cancel and replace our stop now that the market has made a new high. And we want to lock in some profit. We just happened to enter the market right where it bounced. But now that it made a new high, let's lock in some profit. Let's cancel and replace, which you will use this part of your form to exit your old stop order and make a new stop order, and look at how we moved our cancel replace from this low to now locking in at least 20 pips in profit or $200. In other words, in this trade, we now have no risk. We are in the market with no risk. Market's up here. Here's our entry. Here is now our protective stop loss order. It is now in front of where we got in, meaning we've locked in profit. Now the market continues to rally. Look at how it rallied up, came down, and established a new low, and it's now on its way. So we would cancel replace from this low to this low. Use your trading software form to fill out your paperwork. Now that the market has obviously incurred a fundamental day, it has rallied, established a new high, retraced back, U-turned, and now is making a new high. We're going to cancel and replace our stop loss order from this low to this new low. See how we're chasing the market? We have now locked in 288 pips or $2,888 per lot. If I was trading 10 lots, I've locked in $28,800. Just multiply that by 10. Look at how our moving average buy indicator is telling us the market is turning very bullish. Obviously, the market is bullish, and that makes us very happy. We will cancel replace again using our trading form. Look at how the market literally rallied 1,000 pips from our point of entry. We got in here. These are pips. Market rallied 1,000 pips, and we're still chasing it. So now it's time to cancel and replace. It's established a new low. Let's cancel our stop order from this low to this low. See how we did that? We've now locked in $4,860 on this one lot. 10 lots, $48,600. How high will this market go? We have no idea. People that traded tech stocks, as they watched those tech stocks rally, they had no idea how high it was going to go. Educated traders canceled and replaced their stop orders so that when the market decided to turn around and fall like it has, they were able to cash out. Many traders, many uneducated traders watched the market rally. Boy, they were millionaires on paper. But then as the market U-turned, the market took away all their money, and people are still in the market today hoping and wishing that the market would return. Now, the market falls faster than it rallies, and the reason why it falls faster than it rallies is because the market is driven by fear and greed. Fear is a stronger emotion than greed. It took literally less than a year for the market to fall to the point that it took over 7 years to gain. But those traders that educated themselves on how to properly cancel and replace ended up making a bundle and preserving their capital. This is how you, in an educated way, preserve your capital. As the market continues to rally, you cancel and replace, chasing it, moving your protective stop loss order to the last low. Our new order is right here. We've locked in $4,868. Or $4,860. The worst thing that's going to happen to me right now in this trade is when this market falls, it's going to stop me out and I will make $4,860. That's the worst thing that's going to happen. Well, let me tell you something. These are the types of problems you need as a trader. Educate yourself on how to cancel, replace, and hopefully you'll be living with a lot of days that have these types of problems. Now let's watch how the market slowly came down and now stopped us out. Now that the market stopped us out, we have literally locked in and put in our account $4,860. Your computer software program will keep track of that. But be that as it may, fill out your paper trading form, print out your chart so that you have reference to go back. Now here's trading strategy number 4. This is fair for sideways markets and good for trending markets. You'll enter with 2 lots. You'll have a protective stop loss order on both of them. You'll exit with 1 lot for a small profit before the market makes a new high. And the second one, you will figure out your Fibonacci numbers, your extension, and you'll get out right before it hits the extension. Remember, your protective stop loss orders are at the last low if you're a bull and the last high if you're a bear. If you can't afford the trade, stay out. We find a trade, we enter the market right here. Our stop's at the last low. We exit with 1 lot right before the market makes a new high, and then we exit with a second one right here before it hits the 1.618 extension. It'll work the same way in a downtrend. We short it with 2 lots, we'll exit before it makes a new low, and we'll exit with the other one right before it hits the extension. That's strategy number 4. Strategy number 5 is good for trending markets and bad for sideways markets. But you enter with multiple lots, for example 5 lots. You'll have a protective stop on all lots. You'll get in on a limit exit order on your lots and you will start to exit the market, selling them one at 40 pips, one at 60 pips, one at 100 pips, one at 150 pips, and one at 200 pips. Once the market has started to trend and it has moved 100 pips or more, you will cancel and replace your remaining lots to a break even to eliminate your risk. Remember, your protective stop loss orders must be at the last low and last high, and if you can't afford the trade, stay out. But if we buy right here, we will buy with multiple lots, for example 5. We'll place an order for one of them to get out at 40 pips, one at 60 pips, one at 100, one at 150, and one at 200, which means as the market starts to move, we are ringing the cash register, making $400, $600, $1,000, $1,500, $2,000 on this lot, and we will exit with a total of 550 pips or $5,500 on all these lots. It works the same as we short the market. You'll sell one at 40 pips, sell one at 60, sell one at 100, one at 150, one at 200. These trades are great in trending markets. Look at how we exited. Look at how the market only moved 200 pips, but we captured over 550 pips. Now, trading strategy number 6 is good for trending markets and bad for sideways markets. We enter with multiple lots, 5 lots. We have a protective stop on all lots. We limit exit our lots one at a time, one at 60, one at 100, one at 150, one at 40, one at 60, one at 100, one at 150, and on the last one, we cancel and replace, just in case the market might move 1,000 pips. Now, once the market has started to trend and has moved 100 pips or more, you'll cancel or replace your remaining lots to a break even to eliminate your risk. Remember where to place your stops, and if you can't afford the risk, don't trade. But what you'll do is you'll enter the market with multiple lots, example 5. You'll sell one at 40, one at 60, one at 100. When the market moves 100, we'll cancel or place our stop and move it to where we got in, or we'll even lock in some profit. And then as the market moves 100, 150, 200, we'll cancel and replace until we get stopped out. Now the same works on a downtrend. Enter with multiple lots, sell one at 40, one at 60, one at 100. Once the market works at 100, we'll cancel or place our original stop to where we got in or in front of it, locking in profit. We'll sell another one at 150, and then we'll cancel and replace based on the rules of cancel replacing, locking in profit just in case the market moves 1,000 pips. Now, if you're chasing the market for profit, you cannot cancel or replace your order until the market makes a new low or high. If you enter a 618 and the market begins to rally and you cancel and replace your stop loss order to the last low, which is the 618, you could get stopped out early if the market returns to a 786 and bounces first. Now remember, only cancel and replace to the new last low after the market has made a new high. The reason you want to trade those 618 and 786 Fibonacci bounces in the direction of the trend is because if the trend doesn't work out, your losses are small. Don't forget this. Uptrend price swings, if they bounce at the 38250-618, they should go to the 1.618. If they bounce at a 786, they should go to a 1.27. Look at how we entered here at a 618. Market bounced. We anticipated a 1.618 extension profit, but instead it returned to the 786. Now that it returned to the 786, we need to cancel and replace our limit order. If we would have entered the 618, canceled, replaced right after it rallied here, look at how it came back, formed a Gartley, which we learned in lesson 13, bounced at the 786, stopped us out. We were unable to participate in any of this profit here. You can't cancel and replace if you enter at a 618 until the market has either done one of two things: taken out the previous high of the original price swing or bounced off of the 786. Once it bounces at the 786, you can cancel and replace, because the 786, it will be the last level of support in an uptrend and resistance in a downtrend. Remember, the 786 is the last level of hidden support. If the market takes out the 786 and exceeds 88% of the latest upswing, the market has a high percentage chance of reversing. Once the market has bounced at the 786, it is now clear to move your protective stop loss order to the last low. That's important information. Memorize it. Look at how we bought this 786. We anticipated a bounce and a rally. We thought the market was U-turning. We bought a trend line bounce. Market comes down to the 88%, bounces and rallies. We bought this 786 trend line. Now that we bought it, we can now move our stop from the last low to the new low, or the 786, because bottom line is this: if the market U-turns to reverse and take out that low, the market will reverse. We're just trying to save some money. You can even reverse your position and go with it to make up some of your loss. Here's another important information. If you're chasing the market for profit, you cannot cancel or place your order until the market makes a new low. If you enter at a 618 and the market begins to dip and you cancel or place your stop from the high to the 618 new high, you could get stopped out early if it returns to the 618 and bounces before it goes to the extension. So once again, only cancel and place to the new last high after the market has made a new low. Now, please understand your Fibonacci numbers and numerical sequence. If the market bounces at a 38250 or 618, it should go to a 1.618. If it goes to a 786, it should go to a 1.27. Keep in mind your original price swing. Look at how if you shorted the 618 bounce and you canceled your stop and replaced it to a 618 bounce, look at how the market formed a Gartley, which is less than 13, only returned to the 786, doing its natural thing. You canceled and replaced. You were stopped out right here, but the market bounced at the 786 and you were unable to participate in any of this profit. Remember, the 786 is the last level of hidden resistance. If the market takes out the 786 and exceeds 88% of the latest downswing, the market has a high percentage chance of reversing. Once the market has bounced at the 786, it is now clear to move your protective stop from the last high to the 786 high. Look at how we saw a reversal. We saw a trend line break, so we shorted the 786. Our protective stop was at the last high. The market started to fall. Now that it bounced off the 786, it's clear to move your stop to your new high. Depending on which strategy we were using, we could have already profit taken on some of this as it fell. Be that as it may, the market started to go sideways and reversed. As it started to climb up here, it stopped us out. Move your stop after the 786 bounce. Save money on your losses. Now here's the psychology of successful trading. There are many trading systems out there. However, the most important trading system is you. You must have a trading mantra and an education on how the market works with a clear set of trading rules that you will obey. Let's face the facts. We all want the market to move in our direction. Educating ourselves on how the market works will improve those percentages. As you trade and educate yourself, please buy into this. I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management and not let my greed exceed my need. I will never trade without a protective stop. The day I trade without a protective stop, well, this will probably be what happens. You will end up getting lucky, you won't get stopped out, and the trade will pay off. You'll then do it again. The market will be kind to you, and all of a sudden you will have now formed a habit. You went twice without a stop. You said to yourself, see, I know how the market works. And then, because Murphy lives in this computer, the day will come, you think you're a know-it-all, you will trade without a stop, and then all of a sudden, unbeknownst to you, something will happen around the world that you weren't aware of, and the market will move against you. You will quickly turn emotional, you will freeze, you won't have the courage to get out, and you will be liquidated. The only way you're going to last in this business is if you buy into this: I will never trade without a protective stop loss. I will not chase the market. I will be patient. I'll wait till the market sets up, meets my criteria. The market needs to meet my criteria or I will not trade. Now let's all agree. If you're going to be a successful trader, you need to have an edge. You need to educate yourself, and you need to know where to get in and why. You need to know where to get out and why. You need to manage all your risk and lock in profit as much as you can along the way. Did this lesson teach you how important it is to educate yourself before you trade in the markets? Did this lesson teach you how to cancel or place a trade and get to a break even as soon as possible? Did this lesson teach you how to manage your equity? Don't risk more than 5 to 10% on any trade. Do not overtrade your account. Did this lesson teach you several trading strategies? Did this lesson teach you to hopefully never trade without a protective stop? And did this lesson teach you where to place your protective stop loss orders? If it didn't, go back and replay this until you understand all these points. Because the reality is this: only 10% succeed, then enter and trade in the market. Those 10% are those traders that took the time to properly educate themselves. Because successful people and successful traders will do what unsuccessful traders won't do. Successful traders will spend 15 hours a day learning how the market works, day after day after day, practicing before they put dollar number one in the market. They will understand how the market works, so they are not victims of trying to become lucky. Because in reality, if you're trying to become lucky in the market, it'll only be a matter of time that you will become unlucky. And the saddest part about entering in the market based on luck is this: if you are trading based on a hot tip, being told where to get in, you'll have to be told where to get out. When you become unlucky, you do not have the education or the knowledge on how to go earn your money back. That's why paying for education and hooking yourself up with a mentor is well worth its investment. There's a lot of money to be made here in the market. Market traders and ForexTips.com, we're mentors. We teach people where to get in the market and why, and where to get out and why. Hooking up with us is like hooking up with a good coach. Good coaches take experienced traders to higher levels of achievement. We teach people where the gold is in the market. Hooking up with us is like buying a map to a gold mine. We teach you where to get in and where to get out. We teach you how to extract that gold with equity management. There's 16 lessons on trading the Forex that can help you. They all come with trading exercises. Because it does take some spatial intelligence in the market, we're looking at charts. If the charts don't make sense, if they're not visually clear, when in doubt, stay out. But when in doubt, if you want to educate yourself, go to ForexTips.com. We have a chat room that's open 24 hours a day. Go into that chat room. Talk to one of our experienced traders. Analyze the chart with them. They'll give you their analysis on the chart. Compare their analysis with your analysis. But if you are still in doubt, stay out. Because of this 21-day 3% rule, if you don't use it, you lose it. Our focus is to help you stay at 85 to 90% recall so that you can become a successful trader. And on behalf of everybody here at Market Traders Institute and ForexTips.com, we'd like to say thank you for investing in yourself and purchasing this lesson.